He is the founder of Together Investing Club, and
Okay.
we're just trying to make sure that most of the investors and traders in our community or around us are kept aware and understand how the markets work. And who better than you to guide us on how to go ahead and take care of the graphical part of it. I can of course take care of the fundamental part of it, but who other better than taking care of the graphical part of it? So Kunal, Atul sir, I would request you to make Kunal also the co-host so that he can share.
He can share the screen anyway.
Okay, great.
Okay. Okay.
Kunal, can you just try
Yeah.
and
Yeah. Yeah. I'll do that. One second. Yeah. Is it on? I mean, is the screen visible?
Absolutely.
okay, great. So before we go ahead, or before I hand over the reins of today's meeting to Kunal, I would like to share a very personal connect that I have with Kunal. So I was an intern in 2013 when I first met Mr. Kunal Bothra. He was then working with LKP Securities, right, Kunal? If I'm not wrong. He
Yes.
was with LKP and I was an intern with Bajaj. And somehow we did an investors meet. And the investors meet was supposed to be of 1 hour 15 minutes, and it ended up being of 3 hours 45 minutes. And it just kept going and going and going. And there were so many stocks that were pouring in. And Kunal was very patient and he was very accommodative. And I think almost every stock that people asked out of the audience of 50 58 then were all addressed by Kunal, both in medium and long term time frames. And I was moved by his commitment to coming down to a level of a normal person. So we had people who were 60s, we had people who were 40s, and we also had people who were teens and 14s and 16s. So Kunal just came down to a level of the person who was asking the question, and he addressed in a way, or he addressed in a sense where someone didn't want to know of whether a stock is going to go up or down. They wanted to know what is the reason behind it, and Kunal would very generously tell the reason as well. So guys, we come from an industry where people kind of build a cocoon around what they know, and they don't want to share their secrets with other people. But Kunal has evolved in a way where he shares, or he loves sharing what he knows. And the best is he keeps inventing by the path. So I've met Kunal 4 times physically and interacted almost every alternate day in last 5 6 years. But the idea is, every time we go ahead and meet him, every time we go ahead and see him, or every time I have a query that I want to clarify, as a mentor, he has invented so many things that after 2 years or after 1.5 years, when you're back with the same query, you will probably get a different answer with a different way of solving the same problem. So it's very difficult to catch up to him. It's very difficult to keep pace up with him. A brief introduction of Kunal. That was my personal way of knowing Kunal. A brief introduction of him is he started as an associate with Edelweiss Securities. Then he was head of advisory for LKP Securities for almost 6 years, and that's where I met him. That's where we actually struck a chord together. And then he's with ET now. He's the market technician there, and you will always see him on TV. You just have to turn on ET now, and he's always available most of the times on Twitter as well as on other platforms. That's Kunal for you. I'm not taking more time of that. I know you guys are holding up to those questions and answers and all the things that you want to hear from Kunal. So we'll just let Kunal train us on things that he feels is relevant as of today's market conditions. And once he is done, we will also go ahead with questions and answers. Over to you, Kunal. Thank you so much.
Thank you so much, Emmanuel, and thank you so much, Atul ji, for organizing this wonderful club. I heard it for the first time, frankly, just a couple of months back from Emmanuel, and then I just dwelt or thought upon an idea of why not interacting with him. So I think it's a good platform for me as well to interact in Sunday morning. So I'm sure that all of you guys are already awake. Difficult hota hai Sunday to try and wake up, but then part and parcel of the game. 7 days of the work we are working. That's the beauty about markets. You can call it advantage, you can call it disadvantage, because we are learning every minute. By interacting with people, by interacting with stocks, looking at the charts, so much of stuff going on around us. So that's the beauty about markets. And thank you so much for the wonderful introduction. So we'll start off with the topic itself. There's a lot to cover, frankly, because I have to summarize my 15 years of experience in maybe 1 hour, 1.5 hours, or maybe less than that. But then I try and be, as precise and as I would say explanatory as much possible. There are a few ideas which I wanted to dwell upon to all of you guys, and I think that will probably help you, approach towards your journey towards markets. So technical analysis is just one stream which I wanted to touch upon, and I'm trying to cover basic of the technical analysis part. So I'm not sure what the level of expertise you guys have on technicals, but trust me, uh, at the last and at the fag end of the presentation, there's some very interesting stuff which I have for all of you guys. So I'm sure that by the end of the presentation, if you guys are sleeping right now, then I'm sure that by the end of the presentation, you'll be definitely awake and looking at markets as not just a point of making money, but a point of building a huge amount of wealth for all of you guys over here. So, and then there is something which is pure technical analysis, which works extremely well. So just by the raise of hands, how many of you guys actually follow technical analysis on a daily routine? Not as a side profession. I mean, not as a, okay, like daily routine.
Yes, sir, we do follow.
Okay. 6 participants have raised hands. Okay. So only 6. Okay. Most of you guys, I'm assuming, okay, 5. One is reduced. So one is still deciding. Not sure. Fair enough. Not an issue. So the idea with technicals is very, very simple. We are not just chart analysis. We look at lot of aspects. So there's almost every day new stuff which is going across the globe, whether it's the bond deals which have spiked up, whether it's gold which is correcting, whether it's cryptocurrency which is rising, whether it's the crude which is now about 60 $62. So there is so much of stuff which is going on across the globe, and all of them or individually of them have a lot of impact what happens to our market. So technical analysis is not just about charts, it's about what is there inside the charts, what is there in terms of what affects that particular chart or that particular asset class is what we track. So charts is just one tool. It's like, it's like I'll give you a car and you'll have to drive by yourself, but the skill of driving depends and varies from each individual to the other individual. That skill, that art, it comes by experience, and that is what you have to go through those rigors. So you'll have to go through an accident or a couple of accidents to really understand the skill of driving. That's the same stuff which we do on any kind of analysis as well. You have to make those mistakes to try and learn and evolve yourself. So a wake up question first to everyone. Assuming a stock is priced at 100 rupees, now a stock falls by 10%, that stock falls by 10% every day. How many days will the stock turn will take to become zero? Quick answers. A stock priced at 100 rupees, how many days will the stock take to become zero? So this tells me basically how smart the audience is, so that I can maneuver my presentation accordingly. To really, wow. So how many days will the stock take to become zero? Okay, I think my voice is echoing. So this tells me basically how smart the audience is. Saying someone needs to mute the mic. Okay. So Himendra, Gagan, Shivangi, Akshat. Okay. All of them have replied. Stock falls by 10% every day. It's priced at 100 rupees. Very simple, yeah. 100, 90, and so on and so forth. How many days will the stock take to become zero? Wow, you guys are already smart. I'm sensing a lot of reply.
It will be infinite, never time.
Absolutely, absolutely. So congratulations to all of them who answered never, because a stock price, even if it falls by 10% every day, actually cannot fall below zero. That's a very simple way to look at, but that's what the markets always surprise. We always feel that paisa agar market mein dala hai, if the market keeps on crashing, our money actually becomes zero, but it actually never becomes zero. So that's the beauty about stocks as well. Now, how many of you feel that this is which is the better way to look at the markets right now? So I don't know if the screen is entirely visible, but is it the best time to get out of the market, or is it the best time to get in the stock market? Now, I will not answer it right now, but at the end of the presentation, the answer will automatically come to you, all of you guys. But I want to know from your end that what do you guys feel? Is it the best time to get out of the stock market at 15,000 levels or whatever, 14,500 Nifty, 50,000 Sensex?
I think, sir, for a technical analysis, trading is important. So whether it is going down or up, it doesn't matter. So you can enter anytime.
Fair enough. No, not just about technicals. It's about in general. It's about in general. If you are managing your own portfolio, if you're managing your client's portfolio, what is the broader decision which you would want to take over here? Or if you've not entered into the stock market, or you've entered into the stock market already, you're making a lot of money, then what is it that you are taking the call now?
Now you should be wise enough to choose the stock. Your stock should be very choosy now.
Okay, fair enough.
इस टाइम सर प्रॉफिट बुकिंग करेंगे.
Not bad. Good. So as I said, there is no right reply, there is no wrong reply in markets. It's about how much money you make and how much profit you have in your P&L. That's what decides that whether you are actually right or wrong. So that frankly doesn't there's no, as I said, there's no perfect reply that at 15,000 the markets have topped out, or at 14,500 the markets have topped out. It could be a start of a fresh bull market which could last for many years as well. So it depends, the answer depends on each individual to individual, but this is a broader call which we have to take every day, or maybe every week or every month. So every market trend, whenever the markets get into a new range or a new regime. So at 15,000, or maybe a couple of months back, when the indices were at 12,400, where we hit a fresh high for ourselves, everyone thought that maybe 13,000, 14,000 could be a good level. We went to 13,000, we went to 13,500, we went to 14,000, and then the markets kept on rising and rising and rising. Everyone was lost that what is the point when the markets will start to correct, and people have not seen any major kind of a correction. So this is the question which we keep on asking ourselves, as well as the clients keep on asking us, that what is the best time to get in the stock market, what is the best time to get out of the stock market. As one gentleman rightly said, that for someone who's following charts and for someone who's following the trading aspect, there is no best time to get in or get out. Every day is a different day. You just have to try and pick and choose the stocks and be very, very selective with the stock selection. This is the most important part. Now, I don't know how many of you guys are actually trading, but what I've showed over here are two kind of houses. Okay, 1 second. Okay, these are the two kind of houses. Now, you are given the choice to select a house A or a house B. Now, this is purely from a trading perspective. Now, I'm sure many of you guys who are already using technical analysis, or maybe investing, or maybe any kind of a domain, whether it's fundamentals, technical, statistic, sentimental analysis, this is very, very important. Now, if you're given a choice, would you want to select a house A where you have just the walls and your basic framework of doors and windows, or you would want to live in a house B which has a lot of stuff, which has your TV, your sofa, your dining table, etc., etc. What is it that you would want to live in? You would want to live in a house A, okay, or you want to live in a house B?
So according to technical analysis, house B should be important because it will give me more information.
Okay, anyone else? This is interesting because trust me, this is it may seem a bit disconnected towards markets, but when I try and answer this to you, you will find the real connect, that why this is very, very important in understanding the various aspects of trading.
See, it's like defining your portfolio being very wide and very small. That is the way you look at what I feel.
Okay. Okay. That's a nice version. Anyone else? Okay. Simran, house B, Harshita, house B, Granth, house B. Fine. So many of you guys are, I would say a couple of them for house A and many of them for house B. Now, the frank and the genuine reason why this is very important, this differentiation is very important. there are two aspects to look at when we are when we uh, enter into the foray of technical analysis. There are two aspects which you look at. पहले हमको सिखाया जाता है, first when we get into technical analysis, we are first told that you learn a lot of indicators, and then after some point of time, once you understand those indicators, just use one indicator. That one indicator will help you to achieve your goals in market, will help you achieve accuracy. Now we all know that there is no holy grail in the market, correct? I hope you and me both agree that there is no holy grail in the market. Agar holy grail hota, then even Warren Buffett would not have invested gold when the price was $2,000, and he would have not sold off his Boeing shares at dirt cheap prices. So I'm sure that all of you guys are aware that there is nothing kind of a holy grail. Now, when you're looking at technical analysis or any kind of a trading aspect, there are two aspects which you have to understand. One is house A, or the other is house B. What is house A? Eventually, you will have just one indicator where you will want to have your entire trading framework depending on that one basic indicator. For example, we use RSI, Relative Strength Index. I'm not sure many of you guys are aware what is an RSI. So we use RSI as one basic and most important indicator to try and analyze the markets. But there are many a times, I would not say even like 2 out of 10, but there could be even probability or cases where maybe 5 out of 10, maybe 6 out of 10, RSIs does not work. Now, in that aspect or in that kind of a zone is where we lose out on our expertise in technical analysis, because we are restricted. We restrict ourselves. I would not say that we are stubborn, but that we get into a point. Stubborn is probably a higher degree word, but a lower degree word could be that we don't want to confuse ourselves with too much of tools. But the house B is where you have an actual understanding of so many different tools of technical analysis. So you can use maybe a moving average, you can use maybe a RSI, you can use maybe a Bollinger Bands and such other kind of different kind of tools. All you have to understand in house B is that whenever you require that particular thing, so if you want to relax, you will sit on the sofa. If you want to get entertained, you will want to switch on the TV. If you want to if you want to have your dinner or have your lunch, then you would want to sit on the dining table. It's that exercise or that time period, what you want to do, you will achieve that using a house B. The same thing is what we try and train our students as well, that whenever you're looking at technical analysis, you should have an understanding of as many indicators as possible. The expertise or the USP is to use or when to use that indicator, in which market you should use that indicator. So we generally look at the other way around, where we learn a lot of indicators and then we graduate towards one indicator. I would suggest that you start learning one indicator, get expertise in it, but start doing that for multiple indicators and have all those indicators ready in front of you. So whenever the market throws in a different kind of a question, or different kind of a puzzle, that if it's not getting answered by one set of key or one set of a tool of indicator, you use some other indicator. I'll give an example that at some point of time for fundamental guys, I'm not a great fundamental analyst, so you guys can pardon me. But then for some, for a good amount of time, a 30p, for example, for Nifty was a good enough resistance. 28 and 30p was assumed to be a good enough resistance where the markets are overbought, etc., etc. Correct? Same happened in stocks as well, where, for example, depending on each sector, of course, a PE of maybe 60 or 80 or 100 could be an overbought PE. But we've seen at times that the indices have also managed to cross above those PE. I think if I'm not wrong, the trailing PE of Nifty is more than 38 or 40. I think if I'm not wrong. And for stocks as well, the trailing PE has gone above 100 as well. So there are times when the market goes into such kind of an extremes where it tends to throw us out of our traditional learning, which we are succumbed to. So all my urge towards all of you guys is, when you are learning the aspects of trading and technical analysis, have as much versatility as possible, So that's the first and most important part which I wanted to throw upon. So I hope this exercise was very fruitful. The last exercise which I look at, but again, I'm not sure whether this probably would you guys would understand and I'm not sure how many of you guys are actually trading. So there are two types of roads where we drive in. One is a clear road and the other is a congested road. The same happens in markets where there is a clear trend, and the other one where there is a consolidation. जब consolidation होता है ना, which means there is too many people who are entering into the markets, there is too much of whipsaw which happens. In a congested road, we always want to increase our speed towards 60 and 80 and 100. है ना, हम कोशिश करते हैं कि कहीं ना कहीं से maneuver करके we want to get out of that congested road and enter into a clear kind of a trend. But typically, when there is a clear road in front of you, do you want to drive at a speed of 20 or 40? I'm sure that you would want to drive at your maximum speed, which is possible. Of course, without ensuring that you don't meet with an accident. So the strategies are completely different when you are driving in two different kind of roads. The same happens with trading as well. The same happens with trading. When you are into a clear trend, so for example, when you see a breakout in our technical terms, when we say that when we see a clear breakout, we don't want to withhold ourselves. We want to go full throttle when we see a clear breakout. So we don't buy 1 share, 2 share, 10 shares, 20 shares. We tend to buy maybe thousands of shares, maybe even lakhs as well, if that's the case. Because when we are so sure that there is a clear trend, we would want to go full throttle. And on the other hand, when there is too much of consolidation, when there is no clear signs of a breakout, when there is too much of whipsaw, when there is too much of traffic, you would want to reduce your speed and ensure that you maneuver yourself. So you get out of that rough patch and then you wait for that clear trend in the making. The same happens with markets as well. So I hope this is very, very clear. Very important feature, very basic, but then trust me, if you use these qualitative skills, it will always help you maneuver the market very well. We all make a mistake. We all make a mistake when we learn technical analysis or go through those rigorous understanding of indicators. हम उल्टा करते हैं. In a congested road, we want to increase our speed. In a consolidation, we use all those trending indicators so that they can help us get us out of the markets. And the reverse happens where there is a clear road. We always anticipate and probably fear that shayad aage traffic hoga, and maybe let's reduce our speed and go into a or let's not increase our speed, or let's not go into a full throttle mode. So there are two different kind of fears and sentiments which we always go into. So the strategizing part is the extremely important portion over here. Now we'll get into what technical analysis is. So I'm sure all of you guys are already aware that there are many types of research which are available. Fundamental research, you all know, valuation, profit and loss, assessing the balance sheet, etc., for the individual stocks or companies. Technical analysis is where we'll go through a discussion today. It's understanding price, volume, and time patterns. Now, out of all three of them, the most important, now what I call it as a mother of all indicator, is price. Now, majority of the indicators which are derived, like the RSIs and MACDs, etc., are derived from prices. So which is why price becomes the mother of all indicators. So I don't know आपको अगर if you understand the trading lingo, but हम बोलते हैं ना भाव भगवान क्यों बोलते हैं हम? Because all of the analysis, the supply and the demand, the sentiments, everything gets affected with price. So price becomes the mother of all indicators. Then you have volumes and time patterns, which you look at in terms of price chart. So we try and forecast of what could happen to the stock price depending on what has happened in the history. Now, I'm not sure whether you guys have heard about WD GAN. Have you guys ever heard about WD GAN?
Yes, sir, there is a GAN theorem which derived the future and the past of the stock by using. There is an indicator also is there, GAN,
Absolutely.
GAN square and GAN wagon wheel. You can use that in trading views.
Fantastic, great. So nice to hear that, Dipanshu. GAN has been one of the, I would say, the stalwarts in technical analysis. He was there in the 20th century. Start of the 20th century is where he started his career. This guy was a legend in, I would not say technical analysis as such, but then overall market analysis through a statistic means. Now he developed a lot of indicators, as Dipanshu was also saying, GAN square of 9, GAN square of 12, 14, so on and so forth. What this guy did was, he used to use lot of I would say time-based patterns. So not just price-based patterns, but time-based patterns. So he had he's written some 8 books, 7 or 8 books, and he had a very clear statement when he made in his one of his last books. He mentioned that if you give me, and his strike rate was more than 93 to 95% as an average strike rate was 93 to 95%. There have been periods where this gentleman converted $100 into $10,000 in just a matter of 1 month. He took almost 286 trades in 1 month, and these were all registered and tracked by the SEC at that point of time, which is the Securities Exchange Commission. So out of the 286 trade, almost 272 trades went on the right side, with a risk reward of 1:10, 1:30, 1:70 as well at one point of time. Why am I telling you this? Because Gann had made a very fantastic statement in one of his books, that he used to tell individuals that if you give me the last 1,000 years of history of the market, 1,000 data points, 1,000 years of the data points, I can forecast of what could happen in the next 1,000 years. Now this guy was brilliant because he managed to predict the exact tops and bottoms going forward. So in his book, in one of his book in 1917, if I'm not wrong, 1917, this guy predicted that in 1919, the markets will go through there'll be a world war which could happen and the markets will start cracking. In 1927, he writes in his book that in the year 1939, on so-and-so date in October, I think it was 3rd October or 23rd of October, he mentions that date in the year 1927 in one of his book. And he says that in 1939, on so-and-so date, the exchanges will shut down. What happened on that day was Dow futures collapsed by 23% on a single day, and the exchanges had to shut down on that particular day. They had to ban short selling as well, which was the first time when we had seen the banning of short selling for the US markets. So what I'm trying to indicate is that technical analysis is not some black magic or voodoo. It is something which is based purely on statistics, purely on the historical data points. And if you can forecast and foresee what could happen in the future, or what has happened in the past, it helps you predict what could happen in the future. Then there are many ways in which you can do statistical analysis, then sentiment analysis. Nowadays, there are algos which are being developed. So again, without, I'll just brush up to what is technical analysis. It's a means of examining what happens to the price, or the historical charts and market statistics, and using them, we try to predict what could happen to the future price trajectories. I'm sure all of you guys know the basic difference between technicals and fundamentals. Technicals is more towards the theories, the Dow theories, the Gann theories, etc. We use charting quite extensively, and then using plain charting, we've you use overlays of indicators to try and analyze. So what we'll do is we'll just try and assess few charts as well. Fundamentals, as you know, doesn't depend on the stock price as such, but it depends more on the valuation of the company. So it depends on the industry analysis, company economic analysis. So someone, some of the individual fundamental guys, they do top-down approach. Some of them does, bottom-up kind of an approach. So this is the first most important, chart to look at. This is what we call as the business cycle in the stock market performance. Now, I'm sure that, in the last 1 year, what the globe has gone through, this becomes extremely, extremely relevant. Now, the blue chart, what you can see, or the blue line chart is the stock market cycle. The yellow line chart is actually the economic cycle. Now, just imagine, I don't know if you can see the arrow. Now, imagine that the March 2020, we were at the bottom end of the stock market. Okay. The economy was actually going down. Businesses were shutting down. There was so much of crisis and havoc everywhere. What happened from March 2020, of course, that the market started to rise. The economy started to trough out late. Okay. The actual bottom for the economy maybe happened in second half of 2020, maybe Q2 2000, Q2 FY 2021. But the markets or the economy started to trough out late. I think the GDP data which came out yesterday, that itself tells you that for the first time in last 2 or 3 quarters that the GDP has come into the positive. So you can understand that the economy cycle has been so delayed as compared to the stock market cycles. So stock market is the perfect, I would not say the perfect barometer, but it's a precursor of what could happen to the economy with a lag of maybe 6 months to 9 months. That's an average lag, lead towards the economy cycle. Very important because generally when you try and look at the data points which comes across and then you try and assess if the GDP data has come positive or if the GDP data comes out to be negative, why are the markets rising? That's the first question which comes out. If the IIP data comes out to be negative, why are the markets rising? Because the markets feel, the markets anticipate that this could be the end of the negative cycle, and sooner or later you would see the economy going through a revival. So the markets will always preempt of what could happen to the actual economy. This is very, very important. Again, a classical tool. You guys can probably dwell more into detail by googling the data. This is very, very crucial, and one of the most important cyclical understanding of both the stock markets as well as the business or the economic cycle for every country. We'll go into the understanding of price trends now. In technicals, we call three important trends. The first one is what we call as an uptrend, where the prices, as you can see over here, the prices are making a pattern of higher highs and higher lows. So whenever the price is making a pattern of higher highs and higher lows, for example, the prices over here could have been say 100, starting point is at 100. We moved up to say 105 in a matter of couple of days. Then the markets corrected, we went back to 102. So we say that this is a correction. Then the markets made a new high, stock went to say 110. It corrected, came back to say 107, and then made a new high to 115. So in this process where the stock is making a high of 105, 110, 115, and then a low of 102, 107, and say 112. So in this process where the stock or the asset class is making a pattern of higher highs and higher lows, we call that the stock is in an uptrend. When the stock goes sideways, which means it's neither making new highs nor it's breaking the previous lows, which means we say that the stock is in a range, it's in a congested zone. Okay. And the reverse is the phenomena when the stock actually goes through a downtrend where it makes a lower high and lower low. Very, very simple to understand, I'm sure. But again, the most important ethos in which technical analysis or the trend analysis in technicals is based upon. Now we look at few charts. Now this is Tata Steel. This is the chart since last 6-7 years from 2014-15. Now as you can see that the stock started with forming say an uptrend over here. It made a pattern of high, then a higher low, and then a much higher high. What this trend was, this was a classical downtrend. Then you can see that this was the range where the stock was consolidating or sideways. Okay. And then you saw the stock going into an uptrend, then a downtrend. And here again, the stock is forming into an uptrending mode. Now this visual analysis is very, very important, extremely important visual analysis. So that's what I said, give more emphasis towards price analysis. Very, very important. Based on this, what is the judgment which comes across? Is the stock in a downtrend? Is the stock in a sideways trend? No. We rule out those two possibilities and we say for sure that since last 10 months or 11 months from this bottom of March 2020, the stock is in an uptrend. Okay. There are many ways in which we can check, recheck, and double check that whether the stock has actually broken that trend or not. So we'll discuss few of them in the next few slides. So basically what leads to the price moving up and down? Now the basic analysis is that the prices move up and down based on supply and demand. Supply and demand means if there is too much of supply in the market, for example, what happened in March 2020 or Feb and March 2020, where there was too much of selling in the market, everyone was panicking and they were like, they want to get out of the market. They want to ensure that they liquidate their portfolio and get the hell out. So there was too much of supply which was coming into the market. When there's too much of supply, they don't look at the prices. They will just want to exit their portfolio at any cost. So that results into the prices going down. And then when there's too much of demand, like what we are seeing in the last 6-7 months, all of a sudden there are new Robinhood traders who have come across, or maybe new breed of investors who have entered into the markets, and everyone wants to put in their money into the market. So which means that inherently leads to stronger demand. Now, the more the demand, the more is the the more is the likelihood where the prices will go up. So this supply and the demand, we talk of it on more general or the holistic basis, but this happens regularly for even an intraday trader as well. So when there is a negative news for a certain stock, for example, if crude is going up, now I'm sure you guys must be on Twitter as well, and you guys must have heard a lot of tweets that if crude is going up, Asian Paints is going down. So if Asian Paints is going down, which means there is too much of supply and there is less of demand. Correct? So that's the short-term analysis as well, that prices go up and down, or prices go into an uptrend, into a sideways trend, or into a downtrend, depending on the supply and demand equation for that particular stock. This is the most important aspect. Now, for a fundamental guy, fundamental guy would probably place a fair target. So what fundamental guys do, they evaluate the company, they look at the balance sheet, etc., and they would evaluate that the fair price or the potential target price of the stock, say for example Reliance Industries, the potential target for stock is at 2100. Do you think that actually Reliance Industries will stay at 2100? Will it ever stay constant at 2100? No, right? Very, very obvious. What changes? What happens into the stock? Every time the stock comes at a particular level where it wants to be at an equilibrium, there is a new set of data point which emerges. कुछ नया news आता है ना? Some new news, some interesting development which affects the stock directly or indirectly. Like something could happen across the globe. It can affect the indices. In effect, that could affect the stock as well. Or that could be something individualistic, which can happen to that stock at that point of time in terms of news flow, which affects the stock prices. So prices always want to be at an equilibrium mode, but a new trend emerges as new information gets seeped into the stock price. So stock goes into an equilibrium price, suddenly there is a new information and the stock changes its direction and moves to a lower equilibrium price. Now imagine you have such kind of a news flow which comes out every day. For example, if a stock announces its result, and assuming the results come out in stages. First, the company announces its PAT numbers. PAT numbers are lower, stock drops to a lower volume. Then there is new information that maybe the sales have also dropped significantly. Stock drops to a newer level. Margins have dropped. Stock drops to a newer level. Customer has, or the company has lost new customers or old customers. Stock drops to another level. So the more the information gets come into, the stocks will adjust to that new information. And this is how cumulatively we look at the stock prices moving up and down. So I hope this is very, very clear to all of you guys that supply and demand gets affected by the information news flow, which happens into the stock price or the asset class at that point of time. What are the factors which tends to promote technical analysis? Information does not flow within the market at the same speed. Now we all know that right now we are into a highly digitalized world, tech savvy world where information flows at a rapid speed. But there have been so many instances which I can share with you guys that information actually flows at a variable speed. For example, for someone who's probably not connected towards say maybe WhatsApp, or maybe he's out of network, for example, he may be able to see certain set of a news flow after a couple of hours. But by that couple of hours, the prices would have already digested, because there have been already a new set of or an existing set of traders or market participants who've already listened to that news flow, digested that news flow, and ensured that the prices have adjusted towards that news flow. Then someone else could probably listen to that news flow, and maybe come out with a different set of a criteria of valuating the news flow. For example, Bloomberg terminals. I don't know if you guys are aware. Bloomberg terminals has one of the fastest way in which news actually comes into that terminal. Then it gets reflected to television. Then it gets reflected from television to your individual WhatsApp chats, and from your WhatsApp chats is where you pass it on to your friends or your colleagues, etc. So there are layers of dissemination of information, and all of those layers indicate that the information doesn't flow at the same speed. There is always a variable speed which happens. The other factor and most important factor is that people tend to follow the herd. Now, all of us are now, wanting to invest into markets. Why? Or wanting to invest in one particular stock, because at some point of time, it is but natural that if your friend or your colleague has made money in that stock and he keeps on making consistently money in that particular stock, you will think that there is something very interesting and something which is like magic, which works in that particular stock. So you would want to follow that herd mentality towards that stock itself without actually knowing maybe the basics or the reasons why the stock is moving up or down. So there is this natural herd mentality which happens in the stock or in the asset class or in the overall market as well at all points of time. So based on all of these factors is where the stock prices keeps on getting affected every time, and which is why there is an inequilibrium which happens into the market, which causes the higher supply or variable supply and variable demands. Now, one of the other theories which again forms the most important theory of technical. So whenever you read any book or any Bible on technical analysis, it has to first start off with the most important theory, which is the Dow theory. Now, it was a theory which was formed in the 1900s, etc. I would not want to go too much into the historical part, but then there are three important rules for Dow theory, which is very, very critical. The first is that price and volume, they both together, they help to predict stock prices. The second is that prices move in three trends. Now, I shared with you that there is an uptrend, there is a sideways trend, and there is a downtrend. But in effect, prices will go through three structural phases. One is a primary trend, the other is a secondary, and the third is a tertiary trend, or what you can call it as a minor trend as well. And third is that support and resistances become very, very crucial part of analyzing stock prices. So what we'll do is in the next few slides, we'll emphasize more on the point 2 and point 3, where we look at the primary structure of a trend, the secondary structure and the minor trends, and we look at the support and resistance aspect as well for prices. So this is in effect what happens towards the three basic trends. So primary trend is where, for example, from March 2020 low, the stocks would have gone up, gone through a correction phase, and then moved up higher. So the primary trend is the most biggest of the trend for that stock or for that asset class. Intermediate trend, or what we call as a secondary trend, are the ones which are corrective phases, or the ones which are the corrections towards a primary trend. The third aspect is the tertiary trend, or what you call as a minor trends. So those minor rallies which you see, 2 दिन ऊपर गया, 1 दिन नीचे गया, 4 दिन ऊपर गया, 2 दिन नीचे गया. So those minor trends or minor fluctuations is what you call as minor trends. All of the prices for all of these asset classes or all of the stocks move into these three fashions. The majority of focus is always given to understand the primary structure of the trend. So when I shared the charts of Tata Steel, for example, to all of you guys, the idea was to give you the broader trend, the big primary trend for the stock. You know that the primary trend is on the upside. So for example, if you go back again, yeah. So this is the primary trend. As you can see, this is the primary trend for the stock for Tata Steel from year to year. Say from those 2015 bottoms towards 2017-18 highs. This is the primary trend. These are secondary trends or intermediate trends where you see corrections. These are corrections towards the primary trends. And the daily fluctuations, as you can see, those small candles which happens up and down, up and down, up and down candles. These are the days, or these are the trends where you call those minor trends or tertiary trends. So I hope this is very, very clear to all of you guys. Then we look at candlestick analysis. Candlestick, and I'll not emphasize too much or invest too much of time over here, because these are basic ways in which you can represent a price. OHLC chart, which means we basically say open, high, low, close. So candlestick charts are basically one of the most refinest way of looking at the price in a statistical parameter, or in a pictorial parameter. So price is a statistic, it's a number, but how can you plot a number into a graphical point? So candlesticks, so as you can see, this candlestick over here and this candlestick over here tells us about the prices. So green candlestick, or in this case white candlestick, is what we call as a bullish candlestick, which means the stock may have opened at 100 and could have closed at 110. Okay, so that's the basic way of looking at candlestick charts. And if it's a negative day, which means if the stock has actually gone down after opening, so it may have opened at 100 and it would have closed at say 90 rupees. So we call it as a negative candlestick. So in some charts it's denominated or picture, the pictorial representation is by black candlestick, or at times it's by red candlestick as well. Now this is how a line chart is all about. So I already discussed those charts. Now we come to the support and resistances. Now this is very, very important. This forms this the first most important tool of an way, or rather of analyzing charts. Now, as I said, that the stock or any kind of an asset class gets fluctuated on two important points, which is supply and demand. Now, for example, say a stock like SBI. In fact, what I'll do is I'll give you an actual chart over here. Okay, this is the actual chart for SBI. Okay, just look at this plain price chart. Now, as you can see, the stock was at 150 for last 10 years. So this is in 2009, where the stock broke past about 150. Now, 2009, the stock was at 150. 2013, 150. 2014, 150. 2016, 150. And 2020 again, when the stock, when overall markets corrected, the stock was back at that 150 level, which means that this becomes a strong support zone, or this becomes a strong demand zone for the stock. I hope you are able to understand this very, very clearly. This becomes a strong demand zone. मतलब जब भी stock 150 पे आता है, which means there is too much of demand towards buying the stock. And whenever you see the stock taking support over here, it manages to bounce back again and goes up higher. This zone, so 350 for example, becomes a strong resistance zone, or this becomes a strong supply zone. So as you can see, the stock comes to 350 over here, and you see a correction on the stock coming back to a corrective mode. It consolidates, comes back to 150, goes up higher, comes back to say 350 levels yet again. Okay, but this time the supply is starting from slightly below 350, which means someone is very eager to sell the stock, hoping or expecting that the stock may not cross about 350 mark. So first attempt, second attempt, third, fourth, fifth time, 5 times in the last 10 years, the stock went past or tried to manage to go above the 350 mark. But every time it tried to near, it met with a lot of resistance, which means it met with a lot of demand, or sorry, a lot of supply towards the stock. Because there was too much of supply, which was coming at those 350 levels, the stock just kept on going lower and lower. What happened this time? Yes, there was resistance at 350 level, but then this time, for the first time in last 10 years, the stock managed to break past above that resistance zone, which means that the stock has changed its characteristic. The stock has changed its behavior from typically being a resistance zone at 350. The moment the stock scales or breaks above the 350 mark, we say that the stock has changed its behavior, and now 350 should actually and typically act as support zones for the stock price. So I hope this is very, very clear. This logic is very, very clear to all of you guys. Same happened with Reliance Industries. So as you can see, so this is the chart for Reliance Industries since last 10 years. I mean, from 2010 2010 to 2019 approximately. So as you can see, the stock was taking resistance at 550 mark for 10 years. Whenever it used to come closer to 550, it used to meet, with a lot of demand, supply. At closer to 300, 350, there was a lot of demand for the stock, which means it led to a lot of support towards the stock. Okay. So I hope this is very, very clear. Moving averages, again, very, very important phenomena. Stock prices manages to bounce back from those moving averages. We'll go into the chart discussion very quickly. So why is this demand and support and resistance very, very important? Because it manages to break past, whenever the stocks break past about their supports and resistances and start off into a new range, they come into a new trend for themselves. This is an inverse head and shoulder pattern. So again, this is again a price-based pattern, which means, as you can see, that this is a shoulder, this is the head, and this is a shoulder again. So inverse head and shoulder patterns are very strong reversal patterns for the stock prices. Whenever the stocks breaks past about those inverse head and shoulder patterns, we say that the stocks have, or the trend has reversed for the stock, and it started an uptrend for itself. And then one of the other tools is where we look at the price analysis, where we look at pure candlestick chart pattern. So as you can see that this pattern over here, this is the chart, so I think for DV slab, the pattern over here. So the stock has fallen very sharply. The pattern over here is that the stock has gone through a hammer pattern, a bullish hammer pattern, where there has been a lot of demand to the stock prices. So the stock was falling down. All of a sudden at 500 levels, there was an urgency for someone who felt that maybe the stock is oversold at 500, and he feels that the stock is available at a good value zone. So at this price at 500 is where they will start buying the stock and the stock goes up higher. So hammer patterns are strong, reversal patterns is what we see. This is how we identify long-term structural trends. Most classic way, the high, so this is a pattern where the stock makes a pattern of higher highs and higher lows, charts of Infosys. The previous high becomes a support. The previous high actually becomes a support. This is the classic way to look at the charts where it forms an uptrend. We use channel patterns. We use rising trend lines on the upside. They say, using this, we can figure out that the stocks have a higher probability of taking support and resistance in these bands. Now, the moment the bands are broken, we say that the stock goes into an extreme mode on the upside. Okay. Now, this is what is very, very important. Now, the beauty of technical analysis is that prices behave in a very rhythmic or rhyming fashion. Now, this is the charts which I had given on Bank Nifty in 2018. Now, as you can see, there is a structural pattern over here for 2000 and 2018. So 18 years of history for the Bank Nifty. What I've done is I've just mapped up a pattern. So these prices have converted it into an abstract kind of a figure. Okay. The beauty about technical analysis or prices moving in a rhythmic fashion is it extrapolates into different time frames. So this has been an 18 years of pattern for Bank Nifty. And even in 2000 and 2008, a very similar kind of a trend. So as you can see, a similar kind of an abstract trend was seen on the Bank Nifty. Same abstract trend. So what has been in 8 years from 2000 to 2008 as a structure got replicated on the broader time frame as well from 2000 to 2018. Now, someone can probably look at this the quarterly charts, and the same pattern is getting replicated on Bank Nifty, even on the quarterly charts as well. So with this, I'm trying to also indicate that prices move in a rhythmic fashion. So what has happened in a smaller time scale will happen at a larger time scale and will rhythm or will rhyme at a much longer term time scale. So which is why the same patterns will keep on repeating itself for the stock prices or for that asset class. Again, this is from the yearly chart. So again, if you try and put this on 2018 chart 2019. As you can see, in 2021, the markets are rising and the bank Nifty is going into a new domain or a new high altogether. There are many ways to look at harmonic or the rhythmic price actions. We use channel patterns, we use wave theories, indicator patterns, etc., etc. Few of the techniques, and two of the techniques which I'll share it with you guys as well. One of them is the 3S model, where we call that the stock, where it moves, the sign of a classical stock is it moves up higher, consolidates for a long duration of time, and then moves up to a new range altogether. We call this as a slow and steady or a stable price uptrend behavior, where the prices go up. This is, for example, TCS ka price chart. So the prices go up, consolidate, where it tries to dish out the weaker hands, and then moves up to a newer trajectory for itself. The second and the more interesting aspect is the range shift behavior, where the prices will consolidate in a particular range. So this is the charts for HCL Tech. In a band of, say, for example, from May to July, for 2 months, the stock was in a 60-point band. Now, the moment it changes its range, which happens over here, say start of July, the stock remains or goes into another 60-point range on the upside. Okay, so the previous resistance becomes a support, and the stock is now advancing into a new range. And the short and the time duration is curtailed, or the time duration is narrowed down significantly. So we call this as a range shift behavior of the stock prices. So these are few of the patterns in which we try to analyze the stocks. Always remember that a good stock can never stay low for too long. This is very, very classical. What happened with L&T, as one of the most classical cases, L&T remained at 900 for quite an extensive time, even when the stock or the markets were going through full throttle. So a quality stock can never stay low for too long. Like, for example, now Reliance Industries is going through a consolidation. It's remaining in the lower end. So if it's a quality stock and the stock can deliver going forward, which means we know for sure that Reliance may not remain at this low for quite an extensive time. It has to perform and get back into the the performing mode for markets as well. But at the same time, a bad stock or a bad company, for example, can stay at highs for an extended periods of time. Now, these are very, very important rules for us to understand, that quality stocks can never be available at cheap prices for too long, but a bad quality stock can be available at extreme prices for a much extended period of time. Okay, what I'll do is we'll just move quickly towards the observation part. Now, this is very, very interesting. So as I said, the start of the presentation was that whether this is the right time to enter into the market or exit into the market. Now, what I've done is I've done a very simple chart analysis on the Nifty. This is pure technical analysis, and what I've done is I've used price and I've used time factors to try and forecast of what could happen to the Nifty in the next, say, 7-10 years. Now, this is the theory which I had evolved in 2015-16. So I'll just give you a brief on what that theory is all about. So basically, in markets, there are two dimensions which you look at every time: prices and volumes. But then there is this third dimension of time, which is also very, very crucial. Now, one of the tools which helps us understand time function is the Fibonacci analysis. Now, what is Fibonacci series? I don't know if you guys are aware, but Fibonacci series is a number series which starts with the number series 0 and 1. So all we have to do is we have to just add up the previous two number to get the third number. So again, very simple exercise: 0 plus 1, 1, 1 plus 1, 2, and so on and so forth. Important part about over here is that the ratio of the two numbers, for example, 5 divided by 3, 8 divided by 5, 13, or rather 8 divided by 13, 5 divided by 8. As and how we move along, the ratio becomes very, very close towards 0.618. Now 61.8, जिसको हम बोलते हैं 61.8%, becomes what we call as the golden ratio. It's derived from the Fibonacci series. Now, why 61.8 is very, very crucial, or this number series of Fibonacci is very, very crucial? It's found across the nature. So whether it's the spiral, the waves, the ear lobes, the Egyptian pyramid, the palm of your hand, the size of your hand, just the structure of your body as well. Everything is dimension based, and it's in a statistical manner. It's in a Fibonacci ratios. So this number series becomes basically the law of nature, or the mathematical law of nature. Now this is the Nifty chart, and what we'll do is we'll apply this mathematical series on the Nifty chart to ensure and to maybe forecast of what could happen in the future. So we'll start off with analyzing the major tops and bottoms, okay, using the Fibonacci series. Now, this is from 1994, 1995, the data on the Nifty. So what I'm doing, as I said, is we'll look at the tops and the bottoms. So in 1990, in the year 1995, the markets made a top. Rather, 1996, the markets made a high. In the same year, in 1996, the markets made a significant low, which means the difference in the number of years, 96 में high बना, 96 में low बना. In the same year, there was a high and the low, which means the difference between the year is 0. Now, the next is the theory of alternation, where in the year 96, there is a low which has been made. The next high which has been made was in the year 1997. Okay, which means the difference between these 2 years is 1 year. 96 high, 96 low, difference is 0. 96 low, 97 high, the difference is 1 year. Okay, so now we are getting into the mathematical progression. 0 plus 1, 1, which means that the next bottom, so top, bottom, the next bottom should happen in the year 97 plus 1, 98. Okay, which means the next bottom should happen in the year 1998, where the markets, where the Nifty bottomed out. 1 plus 1 is 2, which means that the next major top should happen 2 years from 1998. Okay, that is 98 plus 2, that's 2000. Okay, we've landed back again towards the same exact top in the year 2000. Then comes the next part, where we add 2 plus 1, 3. We add 3 towards the year 2000, which means in the year 2003, the markets should bottom out. So year 2003 is where the markets actually bottomed out, or the new rally started for the markets from 2003. We add the next 2 years, 3 plus 2, 5, to get another number series, which means that the markets have to top out in the year 2008. Exactly the same. The markets topped out in 2008. So what I've done is I've used a simple price and a time-based analysis, statistical analysis, tried to give you a tool of how this works on predicting the tops and bottoms for a major asset class like Nifty. So now in 2008, the markets have topped out, which means the next major structural bottom should happen in the year 2008 plus 8, 2016. Okay, 2016, the markets made a low of 6,900. Okay, this was a major sentimental low for the markets. Commodities, bear market had actually panned out over here, 2016. Okay, markets bottomed out over here. What is the next number? From 8 plus 5, 13. 8 plus 5 is 13, which means from 2016, we are into a 13-year bull market. So statistically, this indicates that from 2016, we are into a 13-year bull market. In every other or every historical portions, whatever the low has happened, the low has never been breached, which means the low of the highest low of this previous market was 6,900. 6,900 was the low. Now, in the COVID correction, or in the Feb and the March correction, what was the low of Nifty? 7,500. So we did not break below 6,000. We were in touching distance of breaking that. But there was a reason why the markets did not correct and went below that 6,900 mark, which was this major low. And from 7,500, the Nifty is now at 15,000. So what this also indicates, that we could probably be in a 13-year bull market and the probability of a topping out of this bull market could actually be in 2029. So this is a very simplistic way of using a Fibonacci series and trying to extrapolate this into looking at what the markets or what could be the structure of the markets going forward in the near future for the Nifty. Now, this is not just the only asset class. This theory, this Fibonacci cycle has worked wonderfully for gold. It has worked wonderfully for Dow, the Dow Jones over the last 100 years. This has worked fantastically for Nikkei chart. I don't know if you have looked at the Nikkei chart or Japan's index, but just look at Japan's index. So from 813, the next number is 21, and then the next number is 34. Japan's index, which is Nikkei, it topped out, I think, if I'm not wrong, in the year 1981, or rather 1982 is where it topped out. 1981 is where it topped out, actually. And for the next 34 years, the index was actually into a downtrend. And it bottomed out in 2010 or 2011. So whenever the 33, 34 years ended up, Dow futures or Nikkei actually bottomed out at those 34, and now it's restarting the next cycle for itself. For the first time, Nikkei has breached above those 30,000 mark yet again. So this Fibonacci cycle works very well on the longer term cycles for the asset classes. Again, just as a summary as well, the ideal zone of analysis is we should know as many parameters as possible. We should try and use as many tools as possible. And the best way of using a rational analysis is a mixture of a fundamental, technical, behavioral, as well as quantitative analysis. And the crux of all of that is what we call as a rational analysis of markets. That's it. Again, I was actually told that maybe you guys are looking out for something on the basics of technicals. So which is why I kept my presentation oriented towards very, very basics of technicals. If you guys have any questions regarding the higher levels of technicals, etc., I'm glad to I'll be ready to answer that as well. Yep, that brings me to the end of my presentation. If you guys have any questions, please shoot.
Great. Thank you, Kunal. So, guys, I know we've been discussing a lot of stocks, and you would have a lot of questions in your mind. So, anything that you would like to ask Kunal, chat box or unmute yourself and go ahead with any questions that you have.
Hi, sir. So I have a question. If you use too many indicators on a single chart, so is it not be a confusing thing for us to trade or take a position, because some of the chart will be saying otherwise? So how does you simplify that set of chart by using some of the less indicators as compared to if you're using the more and more indicators on a single chart?
Fantastic. So very good question, very logical and very apt question. So what I'll do is I'll just share the screen over here once. Okay, so the gentleman has asked a very good question. He's saying that if you use too many indicators, now this is what a typical technical analyst will use a chart. So what I've done is this is the price candlestick over here. The dots which you can see are parabolic SAR. That's indicator number 1. These are averages. The orange line and the blue line are moving averages. This is volume. This is RSI, MACD, ADX. Correct? These are 5 or 6 different set of indicators, which we typically use on charts on a daily basis. Generally, or most of the times, most of these indicators, have a problem of multicollinearity. So as you said that most of these indicators can give you different kind of signals, but at most of the times, most of these indicators, they give you the same signal. For example, let's look at the point over here, or let's look at the broader part. Say this is the monthly charts on the Nifty. Say I use an indicator which is more smoothened. and I will add maybe an indicator like an MACD. Okay. So as you can see, this portion is very, very important. As you can see that when the green line has broken above the red line, this is the RSI, this is the MACD. Generally, there is a problem or there is a double confirmation which will happen, but both of these indicators are very similar to each other. RSI is calculated from a derivative or from a formula of prices. MACD is calculated from a derivative of price. So prices से moving average निकलता है, moving average से MACD निकलता है. Basically, what I'm trying to indicate is that when you try and go into the crux of both the analysis, RSI and MACD, which is a mother indicator? Prices. So the general problem which people face is when they use too many of the same indicators. I hope you are understanding my point. Too many of the same indicators will actually give you the same result. So if I look at RSI and I look at MACD, I can say that I'm getting a double confirmation, but it's actually meaningless for me to look at both these indicators and arrive at a conclusion because both of them are actually derived from the same behavior of prices. So in that scenario, what I suggest to my, what I do practically is I use least amount of indicators and give more emphasis towards prices. So what we'll do, for example, over here. Now this is the pure chart over here. What I've done is I'll remove all those. Okay. This is pure chart analysis, pure price analysis. Whenever you do price analysis, as I said, first understand the primary trend. First understand which is the bigger part, which is the bigger wave of the price moving. If the bigger wave is on the upside, all you have to do is wait for those corrections if you want to time those entry points. So this is for example, this is Nifty chart. You can see that this is Nifty is going to a classical uptrend. So using this channel pattern, very, very simplistic tool again, I can find that these are the points. Whenever the Nifty has come back into these points, the index has managed to bounce back. Okay. So over here as well, then what is the probability over here for the index going up higher? Is the probability low or is the probability high?
So there's a high probability that it can bounce back from here.
Fantastic. The probability is very, very high. So technical analysis is always a game of probability. All you have to do is you have to check your probability that my probability is very high going into that trade. Now, for example, if tomorrow the SGX Nifty is showing say a 50-point uptick, okay, if the Nifty opens up higher at 14,600, for example, which means it builds in all the more important case that now this is a very important support trend line. So this is what we first do. Always look at the price, the structure of the prices, then use those indicators. Typically, I would advise that use or have a knowledge of as many indicators as possible, but use one or two only regularly. So in this case, what I'll advise is that maybe look at the relative strength index. So relative strength index tells you what? That the prices are moving in a particular manner or a particular behavior. So this is a relative strength index. So which means generally we say that if the prices are above a level of 40, so if the prices are level of above 40, which is in this case, we say that the prices are into an uptrend. Okay. So which means the price is still into an uptrend, which means it should adhere towards the trend line. There is a higher probability. Had this indicator broken below the 40, then I would have built in a case that the probability of the stock breaking this channel is far more higher than what it was historically. So I hope I managed to answer your question. There are many ways to analyze chart. The most simplistic way is get into understanding the trend, the primary trend of the prices, and then look at whether the behavior of the prices have changed or not by using a couple of indicators. There are many ways to, as I said, to analyze prices. Now, if I look at the long-term charts, for example, if I look at Tata Steel, okay, I will maybe add, say, a parabolic SAR as an indicator over here. Or maybe use the yearly charts for Tata Steel and use a parabolic SAR as an indicator. Now, what does this tell you? So by itself, are the prices able to signify anything over here? Can you make out any pattern coming out on prices? This is the long-term charts for Tata Steel. Can you make out any price patterns over here? Yes, no, I don't know.
Is it sideways, I guess?
Correct. Very, very sideways.
Yes.
So, but you want to be ahead of the market, right? You want to be ahead before the market actually gives you a breakout. So on a long-term chart, what I will do is I will use a parabolic SAR. Why? Because as you can you see these green dots? I don't know if it's visible to you guys, but if you can just zoom into your screens.
It is
It is
visible.
visible.
Correct. Fantastic. So this green dots, whenever the green dot is breached, which means the previous trend or the downtrend has ended and the stock is now starting a new trend. Okay. So before the price confirms, the indicator has helped me confirm a breakout. So as you can see over here, can you see this? The price. So look at the indicator. This is fantabulous. Can you see the parabolic SAR? Just look at the value over here. The value of parabolic SAR is 756.4. Okay. What is the high Tata Steel has made this year? 753. Which means it is still not broken the parabolic SAR. Now, what will happen if the prices break above that 756.4 mark is that for first time in the last 10 or 12 years, Tata Steel would have confirmed a breakout before the indicator, the other primary indicators like RSIs or MACDs have given you a breakout. This is the first time parabolic SAR will give you an indicator breakout, which means that the probability, like in this case over here, the probability of the stock going into a 4 to 5 year uptrend is significantly higher. Because this is a 10-year consolidation, the probability of the stock going into a 3 years or 4 years of uptrend is significantly higher. I hope I'm making sense to all of you guys.
Yes, sir.
The more the consolidation, the more stronger is the breakout. Okay. More stronger, more durable, more powerful is the breakout. So this is a 10-year consolidation for a high beta stock like Tata Steel. The indicator is just about to confirm a breakout. Now this, of course, after 2 years, you will come to know when the stock is actually would probably hopefully will be at 1500 or 2000 levels. That at 756, this was the first time the indicator has given us a breakout. Now, what if I use say a relative strength index, an RSI over here? Is the RSI giving me any indicator breakout beforehand? No, correct? The RSI is still at 62. The previous top is at 60. So it's not giving me a breakout over here. The RSI will give me a breakout later, but the parabolic SAR is giving me a breakout earlier. So these are just very simple ways in which you have to understand which indicator to use when. Now, again, just I'm going to too much of extension, but this will help you analyzing and understanding the charts very clearly. What we'll do is we'll look at just the plain price charts. Now, if you guys can see over here, okay, what I'll do is I'll just copy the chart and okay. So as you can see over here, just look at this portion very, very closely. Is it forming some sort of a pattern?
You can't see the difference.
Like an inverse head and shoulder pattern. Can you see this?
So we can't see the screen, sir.
Can't see the difference. You have to share the different screen, maybe.
Okay, one second. Okay, can you see this now? So what I've done is I have just drawn some pattern on the prices. Now, if you look closely, what the stock is trying to do is it's trying to form a triangle pattern. A triangle in the sense, can you see this? Now, can you see this?
Yes.
So the bottoms are increasing every time the stock is trying to test the trend line, and the tops are remaining the same. So I shared some charts like SBI with you, where I showed that for 10 years, the stock remained in a band where the support and the resistance were absolutely tight. The moment it was taken out, you saw the stock moving from 350 to 420, 425 in just a matter of few days. Now Tata Steel is showing the same chart for 10 years. The supports are rising, the resistances are constant, and prices are about to break out of this resistance. So this could probably be an ascending triangular pattern. Ascending triangle means this type of a ascending triangular pattern. So I hope this is again very, very clear. So basically what I'm trying to emphasize again is that go back, always give more emphasis towards the price analysis. Use indicators, one or two indicators as a confirmation point, whether the indicators are giving you a confirmation. Now, which indicator to use at what chart, that of course experience will tell you. So I hope I have answered the question. I took more, time to answer it, but I thought probably going to detail is far more important. Okay, some guys have questions. Okay.
Yeah. So I think you're going through the chat box.
Yeah. So Gagan Narang, okay, high bounce back Monday seems green. Perfect. Outlook on silver chart. I'll share the chart with you in some time. Kunal, so all of the analysis were done on long-term basis. What would you like to suggest if one wants to trade daily and the life of a would not be more than 7 to 10 days? Fantastic question. What parameters or technical indicators should one lay emphasize upon with utmost sincerely toward daily trading? Fantastic. So good question. I'll share the screen once again to answer the question. Okay, so this is the chart for, say, give me a stock, Tata Chemical. Okay. So what I'm doing is for Tata Chemicals, I want to see what is my short-term trading rationale. So what I'm doing is, first I will understand the price structure. The prices are going to an uptrend, or maybe I'll look at some other chart, something which is breaking out. Any charts, any stocks which you want to analyze?
I guess Bhale has just given a breakout.
Superb. So okay, fantastic. So we look at BHEL. Okay, I'll remove all the existing trend lines. Okay, this is the Cora chart of BHEL. Okay. Now, first and foremost is I will give emphasis towards prices. Now, this is the previous price resistance. Okay, mota mota. So this is the straight line, which means 44 was the previous resistance. Okay. So the first indicator which I'll use is I'll use prices. As you can see over here, the stock tried to break past above this level of 41 three times. It failed. It went down. Now this correction which you have seen is a correction to ensure that all the stop losses gets triggered. Okay, all the stop losses which are being placed gets triggered. Then the stock moves up higher, starts an uptrend. All of those who buy again at the uptrend, they make money, and then they are forced to wait again. Then, assuming they manage to hold on to their positions, yet again over here, the stock manages to rise up, going down again, and then going up higher. Which means, what is the price telling you? After this wave of correction or stop loss hunting point, which means this zone becomes the most important support for the stock. Most important support is this. Okay. And this becomes the nearest resistance. So what we do is we identify the support and resistance in such a manner. Then we look at confirmation from indicators. The best way, now this is one of the most secretistic way that I'm sharing with you guys, is look at RSI and look at possibly 60 RSI as a level of breakout. Okay. every time the stock manages to break past about 60 RSI, you will see that the stock has started a new trend for itself. I'll give a very simple chart. Tata Chemicals. See what happens towards the stock when the stock breaks above that 60 RSI. The moment the stock breaks that 60 RSI, it goes into a new tangent altogether. So this is what we look at analyzing for charts on a short-term time scale. We use a lot of parameters. I mean, as I said, I use plenty of indicators for charts on the daily time frame. I use Bollinger Bands. This is the Ichimoku pattern. This tells me that whether the prices are going into a downtrend or sideways. Okay. Then I also use Bollinger Bands. One of the charts where I use Bollinger Bands. So as you can see, Tata Steel has come back towards the support of the Bollinger Band, lower end, which means I will use this opportunity to go contra or go for a buy on Tata Steel at current levels. So that's why I said that use a lot of indicators, but know when to use the indicator. Okay. So there is no one short answer to your question in short.
Kunal, how about high beta stocks? I mean, most of them are very concerned about how high beta stocks can be taken in a short-term duration basis.
Fantastic. So again, good question. For high beta stock, one of the indicators which I particularly use, one second, this is ADX. Okay. This is ADX. This is one of the best ways to analyze the high beta stock. ADX, use range bound indicators. Range bound means just zeros and hundreds ke beech mein oscillate hote rehte hain. So for example, if ADX as an indicator, just look at this, maybe I'll break up the indicator into okay. Now this is the green line of the ADX. Let's concentrate on only one point. For a high beta stock like IndusInd Bank, okay, what I've done is I've used the green line of ADX and I'm drawing a line, say a support line over here. Now I know that every time the ADX of this stock comes into this point, the stock becomes extremely oversold. Okay, so as you can see, the last time the stock entered over here was in December 2017. We say that the stock has become into an oversold territory. Oversold say bounce aaya, the stock started to rally up again. Then this time as well, the stock entered into an oversold territory. We managed to buy over here. But what happens over here? The prices make a lower low. But can you see this pattern when the prices keeps on making lower low? I will remove the others. Okay. Okay, the point when the prices are making lower low, can you see the behavior of indicator? The indicator is making a higher low for itself. तो इसको technically क्या बोलते हैं हम?
Divergence.
Perfect. Divergences are the most strongest way to identify bottoms for a high beta stock. The most strongest way to identify bottoms for a high beta stock. Most strong. This works brilliantly on any time frame. ये तो मैंने आपको 60 minutes hourly time frame दिया है. This works very well even on the 1 minute chart or 5 minute charts as well. So I'm using a very simple indicator. At this point, the prices typically should have entered the oversold. As you can see, indicator is oversold. The prices over here should have been ideally at oversold, but the prices keeps on going down. This is inertia movement. This is what we call as an inertia movement. The prices keeps on going down by itself, but the indicator realizes that this is an oversold territory and the prices actually have to start moving up higher, or this is a bottom formation. So prices keeps on going down, indicator makes a higher low. What happens post this? Whenever the prices bottom out or the indicator bottoms out, what starts is a mind-blowing rally. This is a fantastic uptrend. Look at this uptrend. as compared to this uptrend over here. है ना? This was an uptrend which was to the point. जैसे हमने बाय किया वहां पे स्टॉक बॉटम हो गया एंड वहां से स्टॉक चलने लगा. जहां से हमने बाय किया, being technically right, but the prices proved us wrong. What started from here was a divergence, and a divergence led to a start of a new trend. So this was a corrective rally. This was a start of a new trend for itself. This works on all time frame charts. I think if I'm not wrong, Maruti is also showing. अब आपको दिख रहा है ये क्या हो रहा है मारुति में? तो मैंने आपको बता दिया अभी नेक्स्ट वीक में क्या स्टॉक लेना है आपको. So this is Maruti chart. Are you guys with me?
Yes, sir.
Okay. So as you can see, the indicator has entered into oversold over here. So prices 7125 tha. 7125 say prices are going down. Price is going down. But what has happened to the indicator? It has started to make a higher low, which means sooner or later the price will stop falling and there will be an uptrend which should resume. And that uptrend will be a start of a new trend for Maruti. One more chart for all of you guys. Can you see this again? Nestle. The stock is going through a pattern of lower highs and lower lows. Indicator is forming a higher high. A higher high and higher low, which means this is what we call as a classical divergence. If you participate in a divergence, that's the best time to go contra, and the stock will start to move up higher. Gradually, you will see that the stock will start to move up higher. I give you 3 charts instead of 1. Thank God you gave a buy called Maruti, sir, Simran. How would you enter this trade, Maruti, and decide the stop loss? Okay, so deciding stop loss is another, there is a separate tool for that. But in this case, whenever you are entering into a divergence, I would suggest that have a staggered buying trade. So the moment the stock finds a bottom, so when the stock will find bottom is very difficult. So at 6800, ho sakta hai that Maruti can open gap down on Monday at 6800 and then start to move up higher. Wait for that first tick to move up higher. So like we discussed in the chart of IndusInd Bank, for example. Now the moment you see the first tick going up higher, which means the moment you see this wave of price on IndusInd Bank, you know that this support becomes the strongest stop loss for the trade. Strongest stop loss for the trade. So same would be the case for Maruti. So I don't know whether Maruti is at this stage or at this stage or at this stage. So we'll wait for the prices to bounce a bit. But all you have to do is you have to now look at Maruti not with a view that because auto numbers could be bad and the data point could be bad, but we look at the charts very, very objectively. Very, very objectively, because the indicators are giving you a precursor that the prices are about to bottom out. So for Maruti, for example, if the prices bottom out, say assumingly Monday the stocks open up higher. Assuming Monday you have the monthly data, monthly sales data for auto numbers. Assuming if the data comes out to be negative, but the stock doesn't fall, the stock doesn't fall, and the stocks actually starts to rise. What will you say? Arey bhaiya, news to negative aaya, but stock upar gaya. Why did the stock go up? Because the markets have realized, as I showed it to you in the business cycle and the economic cycle, the markets have realized that this is the lowest number Maruti could have achieved. यहाँ से numbers जो month on month आएंगे वो अच्छे ही आएंगे, and which is why the prices will start going up higher. That preemption we get it from our indicators. So I've tried to solve so many puzzles in a very short chart for a chart like Maruti. But I hope I'm making sense to all of you guys. Any other questions?
Kunal, if you would look at silver ones, because of the kind of volatility and the disproportion with the gold in the chart, a lot of people have been curious about that.
Okay, 1 second. Let me just load up silver.
I know, I mean, our expertise lies in the equity domain, but technicals can be, the beauty of technicals is you can apply them.
True. Okay. So
And while you're pulling it up, we also have a question in the chat box where Simran is trying to ask that, we've covered a lot of long positions and how to place a stop loss, but how about doing shorts in the market? So how about playing shorts? Thank you.
wow. Okay. So this is basically the charts for silver. Okay. This is the long-term charts for silver. First, we understand that what is the long-term structure. Now we first look at the major supports, which we call as the demand zones. Can you see this? This was the time when silver corrected in March. It managed to penetrate all the stop loss. It managed to eat all the stop loss. The moment it has eaten all the stop losses, which means it managed to dish out all the weaker hands, it starts a long-term uptrend for itself. Then what we do is we look at the second portion, which is the previous high or previous major high for silver. So this was the previous major high for silver. What the silver asset class has done, it's managed to break past above it, went up higher, corrected down, and now coming back, taken support, mota support at this trend line. Okay, which means this is now an important support line for silver. This is the global prices for silver. This is the long-term structure. Now, as a view, if I have to take a view for silver, I would expect that the asset class would consolidate. So can you see this? This is the high which silver is making. This is the demand zone. So मोटा 30 के ऊपर जाता है, supply zone. 30 के ऊपर जाता है, supply आता है, and 21, 22 के आसपास there is a lot of demand for silver. So in this range, I will use or I will apply broadly the range bound indicators for silver. If I have to use it on the short term charts, so assuming if I do this exercise on a short term chart, I will try and use the same analysis. Can you see this now? The outlook is much more clearer. Now we can see that silver is not going anywhere. So for last 3-4 months from those July highs, silver is into a range. Here it's trying to eat all the stop losses for those who are short. And now it's going down. So possibly I would sense that maybe silver can take support over here. This could be the first port of call. We will then, I typically look at RSIs as the first most important indicator to tell me whether the momentum is lost or not. So as you can see that the momentum is intact, which means the RSI is above 40. So 21 period RSI. Okay. Can you see this 21, 34? These are all Fibonacci numbers, which is why I use them extensively. So can you see this 40? How it's beautifully adhering towards 40 support. So if the price is assuming, if silver doesn't, or if it breaks, there are two cases over here. Silver can take support at this rising trend line. I can initiate a long. My risk reward is favorable. Okay. What if silver breaks below this trend line? Then I will wait for silver, the RSI of the silver to come back towards 40. That will be a perfect level for me to go ahead and give a buy over here. Okay, so if you can see this was the point where silver hit the 40 RSI, and both these points apparently turned out to be bottoms of the channel as well. So it was horizontal as well as horizontal price support as well as the horizontal RSI support. So this is how we typically analyze charts. We look at the first most important tool of prices. Then we use few indicators. I use typically RSI quite extensively. And if both these indicators and prices, they tell me a typical behavior, then I don't follow it up with indicators like MACD, etc., because they will give me one and the same outlook. But if RSI doesn't give me a clear signal, then I will start using indicators, maybe use a parabolic SAR, maybe use ADX and such other tools. Okay. Clear? Simran, I think I had a question on this, right? Or So I hope this is clear.
Yeah, Kunal, couple of shots, or how do we play shots?
Okay, so one of the tools which I've developed for shorts is what I call as it is a modified RSI. So I'll share it with you guys. Okay, so this is on daily chart. Okay, so say for example, if you're using Reliance Industry, which is the short TCS. So what I typically do is I've used an indicator which is a smoothened modified RSI indicator. So it tells me if the RSI breaks its behavior, if the RSI breaks the trend. Can you see this over here? So when the RSI is actually going up, when this is a breakout, so we'll mark this point as a breakout point, and we'll mark this point as a breakdown point, point number 1 and point number 2. So we'll say we'll color this to maybe a blue, sky blue, and maybe some other blue, maybe green. Okay. So these are the two shorting triggers. Now I'll just look at the prices and see what has happened. So you may not be able to short at the top. The first signal which you got was a sell over here, correct? Sell on this candle. Now, if you look at it from this candle, which was the high of this candle, can you see TCS is actually taking resistance? So this becomes the supply zone for the stock. So the first signal was a sell on my RSI. The stock goes down. This support, this initiation point becomes my trailing stop loss. The stock tries to goes up higher. I get a second confirmation signal of a sell. So I add my quantity of short over here, and the stock is actually going down post that. So it keeps on behaving like this. I had gotten a buy call over here. Do you remember buy call on this modified? Okay, this smoothing signal, modified RSI, and what this buy call did was from that initial buy call, the stock started to move up higher in an uptrend. So there are indicators which you can place. This is like a very simple modified RSI indicator. We can take a separate session for that if you want. But this helps us to give a inclination of which are the shorts or how to develop a fresh short. So if you use a typical RSI, for example, अगर आप RSI यहाँ पे use करोगे, then RSI will form a divergence over here. So if I am not wrong, convergence and not divergence, convergence. So RSI is making it, this is a typical RSI. RSI is making a lower low. Prices are also making a lower low. Then we use confirmations that whether prices have broken down of their support, etc., etc. Clear? Okay. Great. So thank you so much, everyone. I hope that brings us to the end of the Q&A.
Yeah.
If there are any questions, I'll be glad to take them. If not,
Just,
you guys can WhatsApp me as well.
just a word from Atul sir, and then I think.
Yeah, I just wanted to thank Kunal. That was a great session. I'm sure all our members have learned something really, really valuable, which will help them at least minimize their losses, if not make more money. So thank you very much, Kunal.
Thank you so much. Thank you so much.
All of us.
I know I covered the basics quite extensively, but then hopefully next time I'll probably try and cover some fantastic indicators for all of you guys.
Thank you. Thank you very much.
Thank you so much. Thank you. Bye.
Thank you, Kunal, for your time. Thank you.